to the TraderMerlin Show. It is your Monday edition. Happy Monday, everybody. Hope you had a great trading day. If you're trading long on the indexes, you kind of a mixed bag out there, but all in all, not too shabby of a day, especially for those of us in the cryptocurrency space. We'll look at the equity markets. We'll run through the top 7 markets near the end of the show as well, looking at some of the interest rates because we had some nice moves in interest rate products. But I want to get this question out of the way. It was a viewer question that came in and really spurred the topic for today. So we'll start off with kind of the housing market crash aspect. I've got somebody asking about Ford. I got somebody asking about Simon Property Group and whatever questions you guys might have today. Hello, Les, Tom, Ketut, Big Gab, Vernon, Ken, George. Good to see everybody as usual. All right, here's where I'm starting with today, and we'll go down any path. And as you guys find anything in particular that you think you want to add to this, let me know. It's obviously an open discussion here because this is just my opinions on the matter. But a gentleman sent a question asking about really how do you profit from a housing market crash? And that question had multiple pieces to it. This is from Will. So Will, thank you for the question. He says, well, what will work better as a hedge against a total real estate market collapse? Things I can think of are A, gold, B, leap puts on builder stocks like Toll Brothers or Lennar, or C, CME housing futures short. Are there any not on this list as well? Yeah, there's actually quite a few not on this list that I would probably turn to first if you really felt there was going to be an overall meltdown in the equity market. Now, that said, you know, we have to look at what's going on in the real estate market right now and look at this almost unstoppable freight train for now. And as they always say in the financial markets, everything works until it doesn't. So while I agree with you, this housing market is way overheated. I think that it's beyond extended. It could still continue up for some time. And unfortunately, if you position yourself incorrectly in something that's trending this strong, it'll blow your account before you even know what happens. So I would certainly wait for some signs that things might be turning, or at least make sure you understand your risk at all times. Now, how about hedging our home, right? We all, not all, but most of you probably understand the basics of looking at your home and saying, all right, I want to have homeowners insurance. Well, that protects you from any damage, but it doesn't protect you from any value fluctuations. If we're looking at our 401ks, we could, if we have the right tools and self-directed, we could go out in those portfolios and be using options and hedging our positions. So if I had 1,000 shares of Microsoft long, I could use options to hedge those shares of Microsoft so I didn't have to sell them. Fortunately for most people in their retirement accounts, they're very liquid. You can get in and out of your positions quickly. As we know, housing markets are challenging, right? It's a big ticket item, kind of tough to unload a $500,000 item or something like that very quickly. There's a lot of time and processes you have to go through. So you can't really hedge it like you would in the equity markets, but there are some things that you could do more broadly, not specifically for your house. So I'll start with the first one you mentioned there, Will, which was gold. Certainly gold would be more of an inflationary hedge. So if we start to see really big inflation, as I believe we are going to see here, then yes, gold would work out well for that. In an all-out market collapse, you know, you have to look at the reality of it. And there's this belief system that when everything falls apart, gold just skyrockets. And I don't believe that's necessarily true. I think there's a period of time of that where it does rally. But if you're somebody who has money tied up in gold thinking that the market's going to collapse, great. What if the market does collapse and all of a sudden you don't have any more money, but your money is tied up in gold? You're going to look at that asset and go, well, it's gone up in value, but I need that money, and you'll end up selling your gold eventually. So I don't think it's one of those a perfect hedge for it. I think there is definitely a hedge component to it, more for inflation, not necessarily a market collapse. So when you have a situation brewing like we do right now, I think gold is probably a very good way to go. As Brennan says here, multi-asset hedging is better. Yes, I think, and that's where I was getting to here. You say, what will work best was Will's initial question. I don't think there is a what will work best, right? All we can do back with anything is look historically and say, this worked well in this era or this era or this era, and this maybe worked well in a different era. So it's about building different ways to hedge that risk. I think gold would probably be a good place to park some capital if you felt there was going to be a housing market or a market crash. Number 2 on that list is one, you talk about leaps on home builders. Okay, so let me start there and we'll go look at some home builders right now. And you could do it more broadly. You don't have to just do home builders, right? You could go out to real estate market, period. I found it to be a very interesting lag time with home builders in the equity market or in the housing markets, as you saw by the equity market collapse and the home builders chart we brought up a couple weeks ago. So if you're looking at things like Lennar, here's Lennar, which has been a rough couple of weeks for Lennar and Toll Brothers. They've all been doing fairly weak over the past couple of weeks. It looks great right now. But if I step back to the monthly, look at the big picture, really just vaulted after the 2000 stimulus. Everything got pumped in there. So could you be buying leaps on this? And for those who don't know, those are long-term options, generally going a year or two. I think it's 18 months or more is really the cutoff point. So anyway, you can go all the way out to Lennar futures right now, going all the way out to January of 2023, at least on the platforms I have. Maybe some will give you further out dates than that. But that gives you about 2 years, a little bit under 2 years to buy these leaps. Now, is it worthwhile? Would that be a potential play? Sure, absolutely it's a potential play. But you have to have that conviction that this is going to continue to sell off here, not all of a sudden rise. Now, the good news with leaps is you have the benefit of time, right? You're really buying time value with those leap options. And, you know, could Lennar tank? Absolutely. I think at some point all this stuff's going to tank. I think things are very overvalued right now, but it can go up longer than I can remain solvent. Markets can remain irrational for a very, very long period of time. So I don't know if I would focus on something like Lennar, or here you mentioned KB Homes. Here's your KB Homes as well. Looking great. Still nowhere back to the highs in 2005, but getting there. I would look more towards housing ETFs and use it more broadly. So as opposed to saying, hey, just home builders and pick one, again, I think there's always risk when you go with individual stocks. I would go more with something diversified like a housing market ETF. I think that'd probably be a safer way to go from a hedge perspective. Now, we could do options, put options on the ETFs, or we'll look at some other options here in just a second. So let me start you off with just three. Leaps are simply long-term options, Rob. That's all they are. It's, generally when people think of options, it's like they expire in a month or two, 3 months maybe. Leaps are when you start to look at a year or more. And again, I can bring up an options chain here real quick. Let me bring it up. I got you, Rob. I got you. Let me bring up my option chain here real quick, and I'll get that going for you. It takes just a second. This thing takes forever to get up. Basically what they are, a leap, I guess by definition, if they're asking about that, it's really a long-term equity anticipation security. It's kind of a weird one. So here's Toll Brothers. I know it might be kind of hard to see because I can't change the font size, but you can see I can go out here 584 days in the future and buy put options on Toll Brothers. And it's not for every security, but Toll Brothers does have these going all the way out to January 20th of 2023. Okay. Making all kinds of weird noise here. Close this out. Yeah, it's more than 1 year. Yep, I said 18 months. It's actually 1 year. So here's the housing ETFs. There's three real main ones, and the only reason I'm showing you these three is these are the ones that are over 1 million shares average daily volume. There are dozens of other housing ETFs, but they're not all very liquid, right? To me, liquidity is key here. So you've got Vanguard Real Estate. That is probably one of the biggest ones by sheer volume. Yep, I had it blank for a while, and it's back up there now, Koja. You've got Vanguard Real Estate, IYR, which is that's the one I use as a proxy for the housing market, is IYR, which is the iShares US Real Estate. And then you have the one we talked about the other day, which is XLRE, which is just a spider, which they built rather recently. It was blank for a little bit. Here's the ETFs. Now, you could go out there with all of these and be buying leaps or put leap options on any one of these if they're available. And basically what you'd be saying is, okay, many, many moons down the road, I expect the housing market to decline. Is it going to happen by 2023? I think you'll probably start to see it really happen in 2023. I still think we've got some room to the upside with all the stimulus and all the money pouring into our markets. So let me bring up VNQ just to look at a couple of these charts here. Here is Vanguard Total Real Estate. Obviously, the monthly is just incredible on this one. It's gone from $55 to $105 since the COVID bottom in 2020. But there's your monthly on that. I'll go back to the daily to give you an idea of how much it trades per day. Roughly 4.2 million shares traded per day. So plenty liquid on VNQ if you wanted to buy put options or simply short VNQ. Number two, which is my preferred, is just IYR. You notice it's probably the most liquid at 8 million shares average per day. Certainly for me, if I'm looking long-term, I want liquidity. It's a key factor in getting in and out of position. So you want to make sure you have liquidity. It has also performed extremely well since that COVID bottom in 2021, which I'll show you here on the monthly. There you go. And that goes all the way back to 2001 when this one was first started. I actually might have been started before that, but this is all the information I have on this chart right here. Now, last one here, which is XLRE, is going to look a little bit different because it doesn't have all that data, but still soaring. And, you know, this is reflected in many of our home prices. I know some of you are homeowners and you're loving it because you're seeing every week or every month Zillow sends you an update going, hey, your house is worth X amount more. It's so much more. It's so much more. Kind of wild. But these ones are absolutely soaring right now. So going short on something that's moving this fast is a bit dangerous. However, I do think in the future there will be some downside here. I just don't know when in the future that is going to be. So that was part of it was, you know, shorting home builders. I would probably look at shorting an ETF, a basket. Even better to help save your time and effort, because some of you, and I don't know, Will, I don't know if you were actually looking at an individual account or for retirement accounts, but if you're in a retirement account, you can't short. You can use other instruments, but technically you can't hit that sell short button because a retirement account is a cash account. However, there are instruments that are built short. So you would literally buy this instrument, but the instrument is short, and that might be another play for you here with regards to real estate. So let me bring up the last screen here. These are short housing ETFs. So basically, the top three are going to be, if you're looking one-to-one, they give you leverage here, which is kind of a nice feature with these ETFs. But you look at REK, convenient name. It's the ProShares Short Real Estate, and it says 1x at the beginning. So when you say 1x, that means if the underlying index that is tracking goes up 1%, REK would lose 1%. If the underlying index drops 5%, REK would gain 5%. So now you don't need to go out to the options market. You could simply buy these inverse ETFs as a hedge against your real estate position or your belief that the real estate market was going to crash even further. Now it gets exponentially more challenging as we start to go into leverage. So here you have 2x on real estate would be something like SRS. This is the ultra short real estate. And then the final one here, which again, I always err on the side of caution here. This is the Direxion. I call it the Super Bear. It's not called that, but that's just my name for it, is DRV. And that is a 3x, meaning if the underlying index drops 1%, DRV should rally 3%. There is a huge problem with these inverse ETFs, though, and that is time. We've shown you this before, but if you hold something for a very long period of time, there's a decay element to it just simply by holding these. And I think I may actually have a graphical representation here. Let me see if I have my SPY. I don't have that one here, unfortunately. Bummer. I'll have to get that one set up for you guys in another time, but I used to have one on here that would basically, I had the single long, double long, triple long, and then the single short, double short, triple short, all on one chart. And you can see that the longer you held them, the more they all would drift down into negative territory because of time decay and of the structure of the instrument. So if you're thinking about holding these for a long period of time, I would not recommend using any of the leveraged ones because time decay will literally eat away at whatever that position is. Even if it's positive, for example, let's say you held it for 2 years, right? You bought DRV, which is triple short, right? You thought real estate's going to go to shit, market's going to crash. I'm going a triple short ETF called DRV. So at the end of 2 years, let's say that the housing market dropped 10%, right? You're thinking that DRV shares are probably going to be up 30% right now, right? My guess is it's probably going to be a loss, a negative, because over that 2 year window of time, the rollover, the way they calculate out DRV, you would actually have lost money. So that's just the danger of, this show is, it's Campbell, welcome back. This show is 14 years too late. Well, you know what? History always has a tendency to reverse itself, right? So be careful. It may be coming around here again soon. Let me go back up. There was a couple questions I didn't get to. Greg said, I'd expect real estate to continue rising in most places except for cities that have become lawless, like New York. I mean, I don't know if New York is lawless, but there are some certain issues out there. I expect it to continue up too until it doesn't. I know it sounds so stupid and like 3-year-old going, I know you are, but what am I? Look, I think this market will continue moving up until it doesn't. And, you know, my gut tells me it's all going to come crashing down, especially when you look at charts like this. I mean, this shows a massive boom. Real estate ETFs shouldn't be jumping like this. I mean, this is less than 1 year, and it's gone from 30 bucks to over 45. That's a 50% increase in real estate in a year. Crazy, right? It's a little bit out of whack, but you know, that there's a phrase that's there for a reason. I love it. I'm not a big tattoo person, but one that I would probably get is markets can remain irrational longer than you can remain solvent. And I can tell you firsthand, I have convinced myself that something can't go any higher, and I've loaded the boat short on stuff many times and been burned on it. So, you know, it'll keep going up until it doesn't. But I agree. I think you'll see it go up for a while. But at some point, the further we extend, the greater that probability is of that market correction, especially when we start to see inflation on the horizon, because really cheap money, which is what we've had since 2009, has been just dirt cheap money, has fueled housing bubbles, or has fueled pretty much all the bubbles that we're seeing right now. They're taking that punch bowl away slowly by the need to raise rates here if we start to see inflation rise. And it's transient, they say right now, but I don't believe it. All right, what else I got? Merlin, if the Fed mentioned tapering this week and the market drops 5%, would you consider buying the freaking dip? Man, I don't know. That's a really, really difficult question, Big Up. I don't think I would personally, and here's why. Look at the charts of the equity markets right now. So they still look strong, right? Obviously, very strong. However, to me, 5%, I'd need more. I need a bigger drop than 5%. A one-day pullback. 5% is nothing really in the grand scheme of things. So I don't think 5% would entice me to buy a pullback, buy a dip, personally. You know, and where would that be? Here's the S&P 500 with some lines on. Let me get rid of some of these lines so I can talk to the chart for you guys. For the podcasters, sorry, but you can't see this chart right now. Let's see, 5% off of this high, where we are right now, would be... Oh, we would get down to there? Ooh, all right. See, now you make me change my tune, Big Ed. This is why I love charts. I figured that was lower. We've had that 4,025 mark kind of on that chart for some time. That's the last big bounce. I made a little bit, but I really don't feel like I want to load the boat or be buying into the equity markets right now. I do think that they're due for a big correction here. And my concern is that we're going to see it not start slowly. I think what you're going to see is a flash crash, and a pretty aggressive one. And why? Why would I think we're going to see a flash crash? Because right now, a lot of people are feeling like the markets are going to sell off, but everyone's just still buying. So we haven't had that shock to the system yet. And it always seems like it does what people least expect. So as we are continuing on, setting all-time highs, as we did again today on the S&P, that's just going to bring more people into buying it, and then all of a sudden, the rug gets pulled out from underneath them. So I would expect there to be a much bigger than 5% drop. Personally, I wouldn't be buying it. So there you go, Big Ed. I may be buying specific companies, but I wouldn't buy the overall market. Let's see, what else do I got here? Gregory, hey, way to be a little bit scared out there. 50% of Americans die from the vaccine. Real estate short ETFs would be hot. Yeah, I'm sure a lot of stuff would come crashing down. I think that I'd be a little bit more humanitarian than worrying about my portfolio. 50% of people who got an injection started dying. I think I probably would not want to be boasting about that one. Farmers are already choosing not to plant their crops this year, plant 25 less than normal. Really, I didn't see that. You know, I'm trying to get... People have asked me to get Don Dawson on the program, and he used to come on all the time. Now he doesn't even return phone calls. I'm not sure what I did to piss that guy off, but it'd be great to have him on because he's into all those reports. Like, I lives in commodity markets, and he's always opening my eyes to new things. But if that in fact is the question, if that in fact is the problem, that they're planting less than last year, then you can expect there to be higher prices next year, which would just further fuel inflation. Typical. I have his entire recorded history and data. I can tell you exactly how correct he was. You talking about me being incorrect? Or Gregory Manarino. All right, let's see. Okay, on the wall chart now, so no one guessed the pandemic. No. Actually, you know what, Adam? I have to boast about that one. If you watch the old Power Trading Radio, I had a guy on the program, and 2 days before the big drop in the S&P in February of 2020, we did a show. It was awesome. It was called How to Protect Yourself Against a Black Swan Event. And it's funny because the next day I went out and I bought a ton of puts. I bought like 40 puts on the S&P 500, which for me, that's a pretty big position, buying 40 puts. And then obviously over the next 3 or 4 days, a week or so, I was like, holy, I did not expect that to come out. So I was literally the right place, right time. We did see a black swan coming. I just didn't think I'd be literally nail it to the T. If you go back and watch that show, I'm not making it up. Okay. All right. Let's see. Merlin's going to... I will, Big Ab. I need to get some people on the show. I got to get more people on here. You guys are getting tired of listening to me talk. So, going back to Will's initial question, how do you capitalize on it? There's number one thing for me would be looking at the ETFs, like the individual home builders like Toll Brothers, Lennar, KB Homes, those. I would probably steer more towards the real estate ones. We're talking IYR is probably my preferred, XLRE or VNQ. You could short those. The challenge here is, I'll show you. If we go short something like VNQ, you can look at the price of VNQ. It's $105. So you would be tying up quite a bit of capital on that one if you did. If you went with the short ETFs, which obviously if the housing market looks this strong, let me zoom out a little bit here. If the housing market looks this strong, what do you think those inverse ETFs are going to look like? They're getting murdered, slaughtered. So let's start with the 1-to-1. Here's REK, right? This thing's just absolutely getting annihilated. Now, one thing you got to know here is look at the volume. I mean, this thing is extremely low volume. It's almost no trades going on. So again, be careful if you are thinking about buying REK. But I wanted to show you just from that peak in November. I'll do this on all of them. I'll go from that peak in November to where we are as of this moment. It's down 29%. That's really doesn't seem that bad, does it? That's not too bad. All right, let's go to SRS. Same thing. I'll go from that peak in November to where we are today. And I mean, obviously this chart is just ugly. It trades a little bit more volume than REK, down 50%, 51%. And lastly, we look at DRV, which is that 3-to-1, and you can probably guess it's going to be closer to 70%. From that peak to where we are right now, you're down about 69% on it. So this one actually has the most volume of the three I just showed you. They're not really popular right now, although volume has been gaining on them over the past couple months. It's still very low volume. So, you know, your capital outlay to buy 1,000 shares of DRV is only going to be $4,900, whereas your capital outlay to short 1,000 shares of VNQ is going to be $105,000. So big time difference there with regards to capital outlay in these. This would be my first choice, would be look at the short ones if you really felt like it was going to happen soon. If it's a 3-year play, 2-year, 3-year play you're thinking of, then I would wait for the market to show its hand and then buy into the inverse ETFs. I would not buy them thinking I'm going to hold them for 3 years because of the time decay. In that case, I may go out there and look at options on some of the ETFs. For example, you could look at IYR and buy leaps on IYR, saying go out 2 years and protect yourself that way. The other way I would do it would be looking at, well, we were talking about specific home builders, we talked about real estate ETFs and the inverse ETFs. You know, gold I don't think is going to be that perfect correlated hedge, but I think, as Brendan pointed out earlier, if we spread it around a little bit and you do some in the real estate, you do some with gold, then I think you'd obviously protect yourself much better for a housing market sell-off if and when it happens. Not if, but when it happens. All right, what else do I got? Let's see. Let's see. Merlin, at what point is it worth it to buy expensive homes with lower interest rates versus, you know what? That's a great question, Medic. That was something I put on myself to study, but I got just way too much going on. I don't know. And what he's asking there is, there comes a point where you look at a house and you say, wow, it was $300,000 2 years ago. It's $500,000 now. Am I overpaying? Or is it okay to spend $500,000 on this home because I'm getting a 3% 30-year fixed, whereas on that $300,000 home, I may have been paying a 5 or 6%. You know, at what point is that change going forward? And I don't know what that breakdown is. Unfortunately, not for me. Since you have rentals, how much do you protect yourself in such a crash? I actually sold out all my rentals. I no longer am a landlord. I just ended my landlordship recently, so I'm no longer in that space. But how do you protect yourself in a crash as a landlord? Well, there are apartment ETFs as well. So as we look at the ecosystem of real estate, obviously you've got commercial, you got residential, you have single family homes. you can actually go and target specific segments of that market and short those accordingly if you wanted to. Yeah, exactly. It would be great. Wouldn't it be great if you could buy puts on your home? It's just a protection, like homeowners insurance in case it burns down. I want to protect against the value of my house. There's got to be something out there like that. Let's see what else I got. This is reminding me of The Big Short. Well, The Big Short was very different. I mean, I think what'll happen here, Dana, in a few years is we'll look back and there will be a movie about this because The Big Short was precipitated because of. First off, because of rules written in our legal system. There were laws that said they had to come up with certain amounts of loans. So when you look at Fannie Mae and Freddie Mac and the lending that was going on, all of a sudden they weren't writing enough loans, so they started dropping the standards. And pretty soon you had people that really had no business buying a home, right? They're making $30,000 a year and they're driving around in a brand new Cadillac and just buy themselves $1 million home. It's like, wait a minute, you can't even make your car payment. And all of a sudden you got $1 million house. And then they leverage that and leverage. Unfortunately, that was a fault of the systems and the financial world because they were over leveraged as well. But in the reality, in The Big Short made everyone aware of, it really had a lot to do with the ratings agencies, which were rating companies' debt and bond ratings like AAA and BBB, those types of things. Really made me lose a lot of faith in Fitch, Moody's, and S&P with regards to I guess their integrity as these rating agencies. So that was a big factor. If we look at our problems facing us today, I'm sure rating agencies will forever be an issue, but is it the same degree of leverage that we were seeing with the Lehman Brothers back in 2007 and 8? I don't think we're there yet. It is concerning to me. I was looking at the current reserve requirements for the banks. And, normally there's a percentage of the capital of your deposits they have to keep on hand. Right now, it is 0. And the reason for that is, obviously, the central bank wanted that money to be lent out. So they don't need to keep any of your money right now. If you deposit $100,000, they can take that full $100,000 and immediately start to lend that out, which theoretically gives them infinite lending power. Because if I deposit, let's say, $100,000 and the reserve requirement is $10,000, they can only lend out $90,000. Okay, the person borrows it, takes that $90,000, deposits it in the bank. The bank can now only lend out $81,000 of that because they have to keep $9,000 on hand, and so on. You get fractional reserve banking. Right now, it's at 0. So if you deposit $100,000, they can lend that whole $100,000 out. That, to me, over leverages the banks and stretches things a little bit. Makes it a little bit scary with regards to how we've got to this position right now, but it is what it is. Hasn't crashed yet. Is it? I didn't see that, Siraj. That'd be great. Yeah, Unscamble says inverse ETFs don't track correctly. Absolutely. They're totally... They track correctly for, like, the day. But as soon as you start to go into months and years and looking at the relationship, they don't track. They're not that great at all. And they'll you know what? I'll do a show where I actually show that because I had it, but I simply closed that chart because I have a special chart just for that. It's pretty awesome to see how that just decays over time. And maybe I'll do that one on tomorrow's show or something like that. Merlin, our real estate price is not a derivative of the debt with the exception of those who bought outright. Yes, absolutely. So if you have the amount of debt, it's not just the amount of debt, it's just the ability for banks to issue loans, right? That's the reason we saw the housing market bubble in 2005, 6, 7, and in early 2008 was because banks were just lending. And it was cheap interest rate time at that. Well, it wasn't too cheap, but they were just flooding the market with money. You look at it now, they're doing the same thing. And they have no reserve requirements, which means they can lend even more. So, if you look at the catalyst for a bubble, that to me is definitely one of them. And remember, we talked about this the other day. What can banks do to help rein in inflation if they finally admit that we have inflation, which I think will be coming here by the end of the year? You'll hear them going, okay, inflation's a problem. Number one, they raised reserve requirements for banks, which all of a sudden means that banks now have to call back loans and pull money out of circulation to put it back into their reserves. Number two, the Fed starts to raise interest rates, and we know that would screw the housing market. And I forgot what the third one is off the top of my head, but none of which of those options is going to be good for the housing market. So, Will, I like your thinking that how do you play the housing market crash? we've seen it happen many times over the years. Again, in the long haul, yeah, housing is going to continue to go up, but that's not to say that we couldn't have a 30, 40, 50% correction again in housing. You look at something like, let's look at IYR because it's got more history. Let's go IYR, and I will go and show you all the history that I can pull up for this bad boy. We'll go back. What do we got here as a daily? Let's go back. Let's go back 90 years. Of course, we know it's not 90 years worth of data, but at least that will allow me to see. Actually, let me go monthly so it's a cleaner looking chart. All right, there's your monthly on this one, and we'll go back. It's going to give me 20 years. We'll go 60 years. Why not? Okay, so here is everything of IYR. So it was started in 2000. You could see there was a monstrous decline in this one. And of course, this was, some would argue, as a one-off event. But the housing market ETF here dropped 78%. Equity markets did not drop 78%, right? But the housing market did. And could we see a similar drop? I 100% believe so. I know some will say not possible, but if we just look at a 50% decline in the real estate ETF, notice where that puts us. I'm going to put a horizontal line right here. Even if we drop all the way back down to $52 on IYR, that still historically would be decent growth. I mean, you just have big wild swings out there. So it could happen. And again, when you take away the punch bowl, you take away the drugs from the drug addict, crazy things can happen. And yeah, it'll be very interesting to see how this all plays out. But Will, I think you're on the right track. I just wouldn't rush into shorting the housing market just yet. It's still really strong, as reflected by IYR and VNQ and these ETFs. Another one that if you were asking me about, let me see if I can get to this one. Lee sent this one. He says, how is Simon Property Group so strong? Great question. I have no answer. I mean, you can look at what happened at Simon Property Group. Here is SPG, which is Simon Property Group. They do malls. And, for the most part, malls have been dead. Now, obviously, I think that this bump that we're seeing is the anticipation of life getting back to normal, and all of a sudden, hey, things are great. The malls are gonna be perfect, and we're right back to where we started. I don't think so. I think that what this has taught us is a lot of people. I'm speaking for myself here, but I'm sure many of you could be nodding your heads to this. A lot of us have become very comfortable and almost dependent on shopping online, whether it's using Amazon or some other source, and you guys all know I'm a total dork. I've self-admitted. I have no problem with that. I literally, on my phone, if you go to my notes page, there's a notes page that says shoes. And I've got probably 20 different manufacturers of shoes. Kenneth Cole, Prada, Nike, Reebok, you name it. I've got them. And I basically went to different stores because it was raining one day here in Southern California. I know, it happens so often. And I went and tried on all the different shoes and found out exactly which size fits me for each brand of shoe. Why? Because now if I'm shopping online and I see some crazy sale on Amazon for Kenneth Cole shoes in a really nice style, hey, you know what? Give me an 8.5. I'm good. I know that that's my size. Yeah, I'm that dork. But it's so much easier for me than actually going to the shoe store now. I'm not going to go to the mall and go to a shoe store. I'd rather just shop online. I think that happens to a lot of people here. Adam, you're holding a Simon Property Group since I'm hoping since $70, not 1970s. I don't even think it was around back then. Good, man. And again, you're on a great win streak here. And is Simon Property Group going to end and all of a sudden just die and roll over? I don't know. I don't think so. I mean, it looks great right now. I mean, it has every constituent of what I'd be looking for, which is higher highs, higher lows, strong uptrend, regardless of the market segment. Forget about it. It's still moving up. So things look pretty good for it. Unscammable says SPG stock prices do not have anything to do with profits or fundamentals. Not right now. Right now it's expectation, right? You're getting hope and dreams is what's fueling a lot of these companies and just expectations. And as we know, there usually is a disconnect between the straight fundamentals, what these companies are actually earning, and the expectations going forward. I mean, that's what leads markets and causes people to buy things is, oh, well, I think it'll be worth more tomorrow or next year or next month. So for me, Simon could keep on going up here, Lee. I don't exactly know why. I think maybe it's the expectation that the malls are going to all of a sudden be the cool place and people are going to kind of move back to them. I don't think so. I agree with Tom here. He says that's called showrooming. Yes. I was talking trash about Best Buy for the longest time. That's when my single biggest loss ever was actually on Best Buy, and I had, I had a lot of, I had a ton of money short on that one, unfortunately, and it just kept on going up. Here, I'll show you. Let's just make Merlin feel miserable today. Here is Best Buy, and I'll do this on a weekly because it's back a few years. Oops. Okay, go .w, and here's the weekly. So I had $100,000 worth of Best Buy short, and I bought all these puts. And if I learn one thing, if you take anything away from today's show, it is this. Don't ever, I have to turn the camera over this one, don't ever, ever, ever short a retail company going into Christmas. It's probably one of the dumbest fundamental things you could possibly do in your life in the financial markets is short any. It could be the most crappy company on the face of the planet. Do not short it going into Christmas. I bought December puts, and I don't know why I bought December. It was just stupidity on my part. I bought December puts on Best Buy. I should have bought January puts, right, after the holiday season. So look what happened to this one. It was the strongest stock on the year, and I was like, screw you, you're going down. And I just kept on buying puts. Notice what happened in January. It dropped from $40 all the way down to $22. That would have turned into really close to a seven-figure winner for me. Instead, it cost me $100,000. Yeah. Yep. Don't short going into a holiday season. All right, let's see. What else? I'm not going to fear in the market. Yep. You know what, Algebra, you talk about that, and you're right. I have been to the mall recently, and it was packed. I mean, it's South Coast Plaza over here in Orange County. It's pretty busy. You know, it's surprising, but that's a different type of mall than I think most. That's a bougie kind of high-end mall, and the people with money still have money. I think the typical mall, like I grew up with when I was a kid, you know, that was. You had Sears at one end, and, you know, where's some other crappy stores? Really just not the best stores were in there. But, yeah, I don't usually find myself going to the mall. Anyway. Oh, well, Dana, just part of trading. Gonna short Lululemon and lost my... but I'm dumped. All right, let me see if I can get one more question here that came through. There's two. One from Keith. And we can keep going down this path, but to me, the whole housing thing is very interesting. I think it's going to give some great opportunities for us going forward, just not right now. Sure, Adam, I could do on my put selling strategy. I mean, it's not really that complex, but yes, I will show you the basics of it. Keith, thoughts on NVIDIA I'm currently holding? Man, I tell you what, if you're still holding NVIDIA, keep holding. I don't see, there's really no reason to sell NVIDIA other than the fact that it's up so much and you're up huge profit. You know, Keith, it really depends for me on where you bought it, right? Here's your daily of NVIDIA, and you can see that since mid-May, it's just been absolutely going almost parabolic, right? 540 to 720 in a very short period of time. Remember, they're going to be doing a split here, I believe 4-1, or I think it's 4-1 split. This is one of those things where it's probably going to continue to run until it splits, which I believe is late July. Not 100% sure on that one. I'll look it up here real quick just to make sure. But yeah, it's when you see splits like this, usually they keep on running and running and running until the split. And the same thing happened with Tesla, right? Split goes into effect July 20th. So convenient. Well, we could see some really interesting things happen in the market. You've got NVIDIA splitting, and you also have Elon Musk going into space. That ought to be a fun one. So 4-1 was the split on that specific date. What else do I got? Yeah, Montgomery Ward's. Oh man, that's really dating. JCPenney's was at the mall. I always liked it just to go and stare at the girl who was the girl who was doing. Remember the hot dog on a stick? They always pick the. I don't know how I say this without offending any viewers. The most voluptuous young lady and they have like a pogo stick in front of the to make the lemonade. It's like this giant pogo stick, and they always have the girl that was. So I used to go to the lemonade place a lot. I was young. I was a teenager. What am I supposed to do? All right. So, Keith, I don't think you should be selling here. If you are, it should be just locking in some profit. Move that stop loss up. For me, I don't know where you bought in, but, you know, right here was the last area of consolidation, which was a week ago. You know, if it gets below, let's say, 685, okay, maybe. Yes, Chris, Santa Rosa Mall. Is this the... Chris, are you from Sonoma State? Is this the one I went to school with, Chris Collins? Yeah, that'd be a strange one. I know. Yeah, 685 is really that line in the sand for NVIDIA. I would just keep moving the stop loss up here, but let it run. Give it a little bit of breather. Until we get that split 4-to-1, expect this to run. Again, we'll look at Tesla as a prime example. Now, obviously, you had Elon Musk pumping it the entire time. But here is when they announced the 4-to-1 split. I believe this. Oh, gosh. That was a tough one. When did they do the split? Because they did back-to-back things. They talked about a 5-to-1 split, and then they talked about getting out of the S&P 500. I believe both of those were in here when it just kept on soaring. Chris, good to have you, man. Say hi to your brother for me. I haven't talked to that guy in ages. Good old Oregon. See, I love when my hometown peeps actually watch the show, or people that might actually I grew up with. Hope the car business is going good, Chris. All right. What else do I have? Last one was this, since we're talking about cars. Heather asked me, he says, if you were to buy Ford, where would you buy? It's so funny because I was always like mentally a Chevy guy, but I always drove Toyotas. Ford, where are we going to look at that one? All right. I think Ford is in a pretty decent spot right now. I know it looks ugly because of the last 6 days. When they made that announcement, the announcement of the Lightning, things just took off for Ford. And I think obviously there's much better pieces overall for Ford, but the Lightning was just kind of ray of hope that this is going to be their saving grace. I think Ford looks pretty good right here. What you have is actually a bullish flag formation, and technically it looks like this. So bear with me. Sometimes my drawing tools like to mess the chart up, but if a bullish flag is where you have a really strong surge to the upside, and then you get this pullback. And the pullback is generally like that consolidation. It's a little bit of waiting for it to come back down to that hesitation. And, oh man, dab nabbit, hold on one sec. Create a copy of this one, a new parallel, and I will show that one to you. Okay, so there's your flag. And the theory is that when this breaks, it usually breaks to the upside by the amount of the pull. Now, it really depends on where this thing's going to break, but let's assume it breaks above out of this flag pattern tomorrow. What would that put our price target at here? Well, you'd have to really move this chart up. It puts the price target at about 21 bucks on Ford. Now, I think that's obviously been very aggressive. I think that there is some opportunity here to be buying pullbacks on Ford. You do see some unfilled gaps, though, right? There's a gap that goes all the way back here to, we'll call it the 26th, 27th of May, which could very easily fill. And there's also another one further down, but I don't think you'll get back down to 12 bucks. That said, I think you're probably doing okay with buying Ford at the right time. Just make sure you have a stop loss in place because this thing did move quite a bit very quickly. I do think you'll probably see it fill that $14 gap. MJ, what else have we got? Oh, cool. Yeah, Chris, I've been doing this for. I actually had another show called Power Trading Radio for a while, but when that got shut down, I just the next day started up this one, which is a little bit more free. I can curse, I can drink whiskey on the show, I can pretty much do whatever I want, but I don't want to offend everybody, so I try to keep it PG-13, at least not with the drinking though. So anyway, yeah, good to have you with us. What else? What time have I got? 44. Big Ed, not gonna happen, brother. I'm not going a full hour today. Too much to do. MJ, you know what? I might look at that tomorrow because I have had 3 questions asking me about MJ again and the cannabis industry. So, that was it for listener questions. Heather was asking about Ford, Lee, Simon Property Group, Keith wants NVIDIA, and then we had Will's great comment and question, which started off the whole damn show talking about how to profit from a housing market crash. So some good stuff there. Hopefully you guys got some info out of that one. I'm going to share a couple of charts here just to, I'm going to bring this over here, just to show you a little bit of supporting information that is still, in my mind, bullish for the equity or for the housing markets. And what you're looking at here is new home sales. Notice those new home sales, they're still nowhere near what we saw in 2005 or 6, but it's been spiking pretty aggressively since 2020. This obviously is impacting things like Lennar and Toll Brothers and KB Homes and stuff like that, but it looks pretty good. Still the uptrend since those 2011 lows. It's been making higher highs, higher lows. So it all looks good from new homes. This is the one that is making me a little nervous. This is the Case-Shiller Composite 20. Oops. Where are we going here? I'll zoom out as much as I can on this one. This is since 2006, and this basically shows you the rate of change of home prices going all the way back into 2006. Now, you look at the 2013-14 peak, that was pretty significant. We're there. We're already at that peak that we saw in 2013 and 14, and it actually seems like we're breaking through those highs. And I think that has a lot to do with the cheap money, the rush for people to capitalize on sub 3% 30-year fixed mortgages, and just buying real estate. So we might see this continue on up here for the next couple months. If it does, that further accelerates the argument for me anyway that we are in a housing market bubble and we could see this thing come crashing down. What else did I have on this one? This was pending home sales. It hasn't really been that good, which is kind of interesting, seeing pending home sales almost every month for the past 6 months since October. Every one except one has been negative, meaning a contraction. They're seeing new home sales slide, which is kind of odd. But anyway, I want to throw those last couple of charts out there for you as we wrap up today's show. Let me see. I do want to talk about guests because some people were asking me about the repo market and how that might impact things. And you know what? I thought there is nobody that I know better to talk about the repo market than Bill Addis. So Bill Addis will be on the program, I think in 2 weeks would be I believe is when he's going to be on. And then I'm going to have Scott McCormick on this week. I don't know whether that is going to be tomorrow or Thursday. I do believe it's one day this week. I tell you what, I'm so dang scatterbrained. Let's see. Tuesday the 15th. So, hey, I got Scott McCormick doing the Beck Report tomorrow, which is great because that means we can talk about bonds, equities, currencies, commodities. He doesn't really do real estate, but we'll talk about those guys on tomorrow's show. So, Bill Addis will be on next week. And I'm going to have Scott McCormick on tomorrow, so that should make it a lot of fun. Again, if you guys have any questions, comments, feedback, whatever, you can email me. TraderMerlin@gmail.com is the easiest way to get in touch with me. Send in your comments, questions. For those that did send in questions for today's show, thank you so much. You helped drive the discussion. For those of you who might be new, let's click that subscribe button. That way you'll see when I do these shows every day, which is at 2 p.m. Pacific time. Owen, trying to catch me last second before I bailed here, huh? I did see somebody else ask about lumber. Yes. Owen says price of lumber could be a cause. Definitely. And let's see, I had the chart up here. Let me make sure I can bring it up real quick for you before we depart. Here is lumber. Lumber has been just plummeting. It's been aggressively coming down, which is crazy. Lock limit down again today. It's lock limited down the last 3 sessions on lumber. But still, even if we get back down to April's prices, it's still showing some inflationary pressure, right? It's pretty aggressive here. And there was a viewer who was actually short on this one. I hope he's still in it. But when you look at inflation numbers, remember, it's not just lumber. You look at things like corn. Corn's not dropping. I mean, it is slightly. Natural gas, still rising there. Crude oil, looking at that crude oil just continuing to rally up. So, much inflation out there that the Fed doesn't want us to talk about. All right. Manorino seems to be the one that I've got to get on the show. I'm lazy and I'm not good at reaching out to people. I'm a horrible networker, just so you guys know that. Ask Chris. Chris has known me since many moons ago. I'm not a good networker, but yeah, I'll try to get him on. If you know him, just say, hey, come on the TraderMerlin show and give him my email. TraderMerlin@gmail.com is the easiest way to get a hold of me. Anybody you want on the program, let's do it. Everybody except you know who. Anybody who works for Pinnacle Trading. Yeah, why'd you have to change your name yet again? How many times are you going to change your school name there, buddy? I wonder if it has to do with the fact that you're no good. Anyway, sorry. That's going to do it for me, everybody. I will see you on tomorrow's show. Scott McCormick talking bonds, equities, currencies. That's the Beck Report. And if you follow Brendan, what he just said, the last C would be for cryptocurrency. I don't think we'll get him on there, but there you go. All right, everybody, that's going to do it. Have a fantastic one. Be safe. I'll see you tomorrow. Take care.